Welcome back, and we have our next section, which is going to be taxes. And depending upon the exam you're going to be taking, you might have quite a few questions on taxes. Although, as I said in that last section on annuities, we've kind of incorporated the tax aspects of life insurance and annuities as we've kind of gone throughout the course here. So a lot of this is going to be review for us. So we'll take a look right in the book here on the top of page 59. And we have the second paragraph there in the top of page 59. Premiums, highlight, star this, paid on an individual plan of life insurance are viewed as a personal expense and are not deductible. Highlight, star this, premiums paid on a group life plan are deductible by the employer if a non-contributory type plan is involved. So there is no individual life insurance policy that has a deductible premium. You cannot deduct premiums you pay for individual life insurance. However, an employer can deduct the premium they pay as a business expense for a group life insurance plan, as they mentioned there. Next paragraph. Policy proceeds are generally exempt from income taxation, even though they may exceed the cost of the insurance. Highlight this. Any payment made to beneficiary out of policy proceeds is not taxable. However, if no beneficiary is named, the proceeds paid out to the estate will be included when valuing the estate and may be subject to estate tax. So I said, as we learned earlier, the estate is the final beneficiary, sometimes referred to as the tertiary beneficiary. Well, if no one else is named, the death benefit is included in the estate. And in that situation, it is used to value the estate for estate tax purposes and may cause the estate to go above the trigger that causes the estate tax to apply. So again, that goes back to estate planning and making sure that you have everything set up correctly there. In the next paragraph, policy loans are not considered income and are not taxable. Any interest accrued and paid is taxable. Remember, when you get paid interest from anything, it's going to be taxable as ordinary income. Remember, never any capital gains tax here. It says, for example, policy proceeds left with the insurer under the interest-only settlement option, the interest payments would be taxable. Dividends received on a participating policy are not taxable, since they are considered a return of overpaid premiums by the IRS. So we went over that in depth as well. In the next paragraph, cash surrenders, however, we're talking about life insurance policies, may generate taxable income if the amount withdrawn exceeds the total amount of the premiums paid in. So life insurance, remember, when you're taking the money out, when you're taking cash surrender, you're only taxed if you receive more out than you paid in. So when you're withdrawing the money from your life insurance, it's first in, first out. You're withdrawing the cost basis first. Only if you withdraw more than you paid in, more than the cost basis, will you have to pay ordinary income tax. Okay, so they give a good example. Read through that of that at the bottom of the page. Last heading on the page, modified endowment contracts. Okay, here's something new. Now, modified endowment contracts, this feature or product, I would say, was created by the IRS. And it says the last paragraph, this federal law, Technical and Miscellaneous Revenue Act, established special rules for life insurance contracts, including endowments, which fail to meet the 7-pay test. So the 7-pay test is administered when all policies are sold at the time of inception of the policy. It's just something they input into the computer. Now, the IRS created this to prohibit people taking advantage of life insurance as an investment, because this happened actually back in the early 80s and on into the 80s when interest rates were very high. I mean, we had interest rates up to 20% in the 80s. Well, people would dump a very large lump sum into a life insurance contract to gain that 18-20% interest, which was tax deferred, by the way, right? And the amount of money that they actually invested increased so rapidly that it exceeded the amount of protection they were purchasing. So by definition, it really didn't meet the definition of what life insurance was created to be. So you could say it failed the 7-pay test. The amount they invested was increasing too fast because the interest was so high, and it was tax deferred, so it was compounding on that. And the IRS didn't like that because it was tax deferred. They wanted to get their cut of everything. So they created under this federal law, TAMRA, the modified endowment contract. So the 7-pay test is administered when the policy is first sold, and it says, last sentence, the insurance contract will fail to meet the 7-pay test if the amount paid in premiums during the first 7 contract years exceeds the sum of the 7 level annual premiums required to pay up the policy. So essentially, if the amount you pay in the first 7 years pays up the policy, meaning no further premiums due, that means the account balance is growing too fast, too rapidly. It fails the 7-pay test and causes it to be classified as a modified endowment contract. So this is something you do not want to happen, because it'll lose, the life insurance policy will lose its favorable tax treatment. You saw this happen to endowment contracts and single premium whole life policies. Top of page 60 says, as a result, any endowment contract that fails the 7-pay test is defined as a modified endowment contract, and distributions for modified endowments are subject to taxation rules that differ from the rules governing the taxation of endowments and life insurance policies that do not fail the 7-pay test. Next paragraph, distributions including loans from modified endowment contracts are taxable as income the time received to the extent cash value exceeds premiums paid. This means distributions are taxed as income first and recovery of cost basis last, similar to our annuities, where it's last in, first out upon distributions. In addition, put a star by this, a 10% penalty tax is imposed on distributions received under an MAC unless the taxpayer is disabled or past age 59 and a half. So 10% penalty like we have in the annuities, that would apply to our life insurance if it's classified as this. It says in the next paragraph, further, persons considering making a material change to their life insurance may find themselves subject to the rules concerning modified endowment contracts. What this is getting at is, when this law passed, those people that already had these policies were grandfathered in, meaning the policies were not considered to be modified endowment contracts. However, if they made a material change, then the policy is reevaluated and the 7-pay test will be reapplied. So they would lose that grandfather treatment, and the policy would most likely be classified as a modified endowment contract if a material change is made. So maybe a question on your exam, what a material change is. That's any change in the death benefit of coverage, as you see in that last sentence. Any increase in the death benefit under the policy. Last thing to mention with modified endowment contract, maybe 2 or 3 questions on it. On modified endowments in total, maybe 1 or 2. All modified endowment contracts issued by the same insurer to the same policyholder within any calendar year are treated as one modified endowment contract. What people tried to do is buy multiple policies to get around the rules, so they added that to the law. Try to eliminate that as well. So we go in the next paragraph on page 60 to the center of the page, and we have taxation of non-qualified annuities. Well, this is that whole section we just covered. In that section, we talked about all the tax aspects of a non-qualified annuity. If you're in stage 1 and you withdraw the money in stage 1, you are taxed as last in, first out. So the first money you receive is going to be the interest that accrued. Only after you withdraw all the interest are you treated as a return of your cost basis. Now also remember, if you take, any interest you withdraw in stage 1 under age 59 and a half, you will have to pay a 10% IRS early withdrawal penalty on. To clarify that, the 10% penalty only applies on the interest withdrawn. Okay? So what else do we see here? Second to last paragraph on the page 60, the first sentence of the second paragraph from the bottom. IRS levies early withdrawal penalties against annuitants who take cash surrender prior to 59 and a half, as we said, unless they have died or become disabled. So those are the situations they waive that. Same penalties exist for early withdrawal of an IRA or KEO plan. And it says the 10% penalty is on the interest portion of the withdrawal. And it says the last sentence there, you can annuitize at any age without penalty. Remember, annuitizing is going into stage 2. The last paragraph says, the first sentence, distributions taken from annuities are taxed as a return of interest first, and only second as a return of cost basis. In addition, taxable amounts may be subject to IRS 10% penalty tax. Top of the next page, page 61, first paragraph says, if an annuitant dies during the accumulation period, remember we said they have a beneficiary, and that beneficiary will receive a cash settlement and they would have to pay tax on any interest they receive. It says though, however, in the last sentence in the paragraph, beneficiary, this is an exception, so just the way it reads is the way it works. If the beneficiary is the spouse, They will not be taxed on the gain in the year of death if he or she elects within 60 days of the death of the annuitant or their spouse to apply the death benefit under a life, income, or installment option. So if it's the beneficiary, they do not have to take a cash settlement. Because remember, if they take a cash settlement, then they have to pay that tax on the interest they receive in that year that they receive it. If they want to spread that tax bill out, then they could take a lifetime or installment payout option. Okay, so before we get into the IRAs here, I want to give some examples on the board here, the taxes, just to make sure we understand it. We'll take a look at 3 different scenarios. And the first one we'll talk about is a whole life policy. Second one's going to be an annuity. And the third one's going to be a TSA. Okay, so the whole life policy, the person is paid in $30,000. This is their cost basis. The account balance has grown to $50,000. And we'll use that example actually across the board when we talk about the dollar amounts here. Now, we'll say that this person takes a partial surrender from their whole life policy of $20,000. And we'll do the same thing over here with this annuity. We'll say that the person takes out $20,000. And same thing over here with the TSA. $20,000 withdrawal. Partial surrender. Okay, so in the whole life policy here, back over here with the whole life policy, they paid in $30,000 of premium, which is their cost basis. Account balance has grown to $50,000. Why did it grow? Interest. Remember, tax-deferred interest in the cash value account. They take a partial surrender of $20,000. And we're going to assume that there's no surrender penalties. We'll say they're beyond that period of time. How much of that is taxable, if any? That's the question. What's the answer? Answer is 0. Life insurance policies are, when distributions are taken, FIFO. First in is the first out. So what's the first money in here? Our premiums. So the first money we withdraw are our return of our cost basis. We are only paying tax if we withdraw more than our cost basis. That's when we start getting into the interest. Okay? That's life insurance. FIFO. Over to the annuity. And we're talking about a non-qualified annuity. Same situation. We've paid in $30,000. Account balance has grown to $50,000. And we take a $20,000 partial surrender in stage 1 in the pay-in period. And we are age 50. Do we have to pay any tax on that? At all? Any amount? Answer is yes. We have to pay tax on the full amount plus 10% IRS penalty on the full amount because it's all interest. Why? We're under age 59 and a half. That's why. So non-qualified annuities taxed on distributions. LIFO. Last in, first out. Last in being the interest is the first to be withdrawn. Okay. So we go over here. TSA. The teacher has contributed $30,000. Account balance has grown to $50,000. They take a partial distribution of $20,000 at age 62. Is that taxable? Yes. Remember, the TSA, this is a qualified annuity. 100% of that money is going to be taxable when they take it out. Plus, they're going to have a 10% penalty on whatever they withdraw if they take the distribution under age 59 and a half. Okay, so there's a lot of aspects here and a lot of things that, can change it around. Say we do this over here with whole life. Say this whole life policy is classified as a modified endowment contract. And this is a situation we paid in $30,000 in premium. Now the account balance is $50,000 and we take $20,000 out. How much is taxable? Answer is not 0. It's $20,000. Why? Remember, modified endowment contracts, the tax rules changed. If it's classified as a modified endowment contract, it's no longer LIFO. It's no longer FIFO. It's LIFO. So we change that to last in, first out. taxed very similar to as the non-qualified annuities, plus 10% penalty on the interest that we withdraw prior to age 59 and a half. So you see they could word these questions a number of different ways on the exam. So you've really got to understand these. Most exams, there's very few math questions. It's usually just a concept thing related to taxes. Okay, so we continue on back in the book on page 61, towards the top of the page, taxation of individual retirement annuities, so IRAs. Now, there's some requirements. In order to establish an individual retirement annuity or account, you have to be under age 70 and a half. Under age 70 and a half and have earned income. So here's a question for you which you might see on the exam. Can a child establish an IRA? Answer, yes, if they have earned income. So, maybe they're Macaulay Culkin and they're a child actor. Well, they have earned income, right? They could establish an IRA. 2 requirements, under age 70 and a half, and you have to have earned income. So you can establish this, highlight the first sentence in that paragraph, and it says in the next paragraph, any individual who earns wages may participate in an IRA. Qualified person may contribute 100% of annual earned income subject to specified maximum limits. A person may deduct the maximum contribution if, so you can deduct your contribution to your IRA if, number 1, you're a wage earner and you do not actively participate in an employer-maintained plan, or number 2, you're a wage earner who participates but you have adjusted gross income below certain levels. So the point being here, some people can deduct their contributions to their IRA, some people can't. Some people can make partial deductions. That's all you need to know. They don't really go any further than that on this exam. You can also, though, establish a spousal IRA for a non-working spouse and contribute up to that maximum we said, whatever the contribution limit is for that year. And by the way, these contribution limits, are in that PDF portion of the class. You print off a contribution limits. Probably won't have any questions related to them, but if you do, they're easy ones, so just kind of skim over that when you get a chance. Next paragraph says, once a person has an IRA, once they reach age 70 and a half, they have to start taking the money out. They have to start taking distributions. Because remember, the growth in the account is tax deferred. So the IRS wants to make sure that they start receiving tax on this money. So they say when you hit age 70 and a half, you have to start taking minimum annual distributions based on your lifespan. And if you don't, they will actually penalize you 50%. So write that in there in the book. There's a 50% penalty tax. 50% of the amount you should have taken as an annual minimum distribution of the IRA, you will have to pay if you don't take the minimum distribution. So that will definitely cause you to take that minimum distribution. Okay, what else do we have in there? Any benefits withdrawn prior to age 59 and a half, you will have to pay a 10% penalty on. It says, in addition, amounts withdrawn must be added to the owner's taxable income for the year in which the distribution was taken. However, if you do take a distribution, you can roll over those funds into another IRA. There is a 60-day limit for this, and obviously the purpose of this is to defer taxation. So it says, also you want to write in there, there's no limit on the dollar amount that you can roll over. It says, reinvested in the new IRA within 60 days following receipt of the distribution. Otherwise, the distribution will be taxable in the year received. Any amount may be rolled over, but rollovers are allowed only once a year, so you can only do this annually. It says the last sentence, rollovers may be subject to a withholding tax, which is 20%, unless it is a trustee-to-trustee direct rollover. This would be where the trustee of your old IRA account cuts a check to the trustee of the new account. That's considered to be a trustee-to-trustee direct rollover. If the check is made out to you individually, then there's going to be a 20% withholding, which, by the way, you can use to offset your taxes at the end of the year. But that's a distribution. If the check's made out to you, that's a distribution. There's 20% withholding, plus you're going to have to pay ordinary income tax, plus possibly a 10% IRS early withdrawal penalty if you don't roll those monies over within 60 days. So you're definitely going to want to do a trustee-to-trustee direct rollover, have that check made out to the new trustee of the new account. Okay, so we have traditional IRAs, and we have the Roth IRAs, last paragraph on the page. Says, contributions to a Roth are not tax deductible. So that's a big difference between the traditional and the Roth. Contributions to a Roth are never tax deductible. However, a big benefit of the Roth, it says, interest earned and distributions made are tax-free. not tax deferred, but tax free. If the IRA is maintained for two requirements, at least 5 years, and the distributions are used to buy a first home, for qualified higher education expenses, or the recipient has attained age 59 and a half, died, or has become disabled. Funds may be rolled over from a regular IRA to a Roth without incurring the 10% penalty, but the funds are taxable, so you have to pay tax on the money before you roll it into a Roth. Now, one last thing I'll mention. We talked about there's situations where in the traditional IRA you can withdraw money without having to pay the 10% penalty. Well, one of those situations would be first-time homebuyer expenses. You can withdraw up to a maximum of $10,000. Write that down. $10,000 for first homebuyer expenses from the IRA without having to pay the penalty on the withdrawal. So you might see that on your exam. Last thing in the section here is going to be on page 62, and we have the 1035 exchanges. Now, essentially, this is Section 1035 exchange, Section 1035 in the Internal Revenue Code. And here's what this applies to. This applies to a rollover of an insurance policy. Now, we just kind of mentioned rollover of retirement plans. You have that 60-day rule, and you can only do it once a year. There's no limit to the amount you can roll over. Well, that's a rollover of a retirement account. Section 1035 exchange is similar to a rollover. It's a rollover of an insurance product. For an example, give an example here. We paid in $50,000 to our annuity. And we'll say this is a fixed annuity. And the rate of return we're earning is 3%. In the general account. We paid in premiums $50,000, and now our account balance is $75,000. So it's grown to that due to the interest. New fixed premium annuities are paying 8% minimum guaranteed rate of return. So this is, maybe we've had this old annuity for 15 years. Interest rates have gone up in the economy, so new annuities, similar annuities, are paying a much higher rate of return. So we decide we're going to get rid of this old annuity, take that $75 out, and invest it into a new annuity. Can we do that? Sure. But remember what we said, if we take the money out of our annuity, this growth year was tax deferred. So we're going to have to pay tax on it. Plus, if we're under age 59 and a half, we're going to have to pay a 10% penalty, right? Well, not so if we do a Section 1035 exchange. So we take the $75,000 out and we use it to buy a new annuity. That's an acceptable 1035 exchange. No current tax. So we're continuing to defer that taxation. Now, there are certain requirements under the annuities and under the life insurance policies you have to follow under Section 1035. You can go from one insurance company to another. You can go from one insurance company to another. The policy, though, cannot, it has to be written on the same life. So if we're talking about life insurance, we have life insurance and we cancel the old policy, use the money to buy a new one. The policy has to be written on the same life, and same thing with the annuity. The annuity has to be written on the same person, but we can go from one insurance company to another. So we have these acceptable 1035 exchanges, number 1 through 4. Highlight the third one, exchange of an annuity contract for another annuity. In the last paragraph says, maybe with the same insurance company or a different company. If the exchange involves life insurance policies, the policy must be on the life of the same insured. If the exchange involves an annuity, contract must be payable to the same person. Okay, so we talked about those requirements. Now, we mentioned, why would a person do this? Maybe because the new interest rates have gone up, they want to get a new policy with a higher minimum rate of return. The purpose you're doing this is, the purpose of the 1035 exchange is to allow me to defer paying taxes. Okay, I'm just exchanging insurance contract. Now, one thing I cannot do, though, one policy exchange that is not an acceptable policy exchange is to go from an annuity and use the money to buy life insurance. So, if I wanted to cancel my annuity here, take that $75,000 out and use it to buy maybe a single premium whole life or an endowment, I cannot do that. Tax reasons, it's not an acceptable Section 1035 exchange. Now, to clarify, I can do it, but I'm going to have to pay tax on the money I get out of the annuity, plus I'm going to have to pay a 10% penalty. And then I can use that money to buy the whole life policy. It is not an acceptable 1035 exchange, and here's why. Now remember, when we talked about annuities, we said, if I die, I'm in stage 1, the pay-in period, I die, I have $75,000 in my account, it goes down to my beneficiary. Does my beneficiary have to pay tax on that money? Now remember, I paid in $50,000 in premiums. Now the account balance is $75,000. Does my beneficiary get $75,000? Do they have to pay tax? Yes. They have to pay tax to the IRS. How about over here though? Say I had a whole life policy with a $75,000 face amount. I die. Does my beneficiary have to pay tax? No. No tax. So in this situation then, I would go from a situation where the IRS would possibly receive money, because there's tax if I die, to a situation where there's no tax. Is that fair to the IRS? No. They say, no, that's not fair. You can't do that. That's not an acceptable 1035 exchange. So if you want to do that, you can, but you're going to have to pay tax. You're going to have to pay maybe a penalty, the money you withdraw from the annuity. Can I go from life insurance to an annuity? Is that acceptable? Sure. I'm going from a no tax situation to a tax situation. Okay? So just remember, really the only unacceptable 1035 exchange would be an annuity to life insurance. Okay, and that is the end of that section. So print off your next section, read that, last section to go, and we will present that in the next video here.